Good. So welcome everybody to our customer exclusive webinar for December, putting the cyber and cyber insurance. We often get asked to help with questionnaires or other questions around cyber insurance that you are working through. And so we thought it'd be a great time to set up a webinar to really talk about what you need to qualify for coverage, how to avoid the most common claim denials, and how to keep up with evolving requirements. It's a very fast-moving market. So with that, I'm going to hand it over to Reg Harnish, who I believe you all know, CEO of OrbitalFire, to take it from there.
Awesome. Well, thank you, Dana. Appreciate that introduction. And yeah, honestly, become a very common conversation for us small businesses. I think really all over the place have been experiencing, I think, in this space a lot of flux, a lot of questions, a lot of confusion. Certainly, I kind of got introduced to cyber insurance back in around 2012 or so. And at that time, it was really only enterprises that were investing in this. And there weren't that many carriers and underwriters that were engaged. But now it's become commonplace. However, there's been a lot of change over certainly the last 3 years. But just in general, it's a market that hasn't really settled down. They haven't really figured out how to do this well. I'll explain why. So thank you, everyone, for being here. And as Dana sort of alluded to, we've got a couple of exciting things coming up. Just want to mention, thank you all customers for being here. We do customer exclusive webinars every other month on different topics. So you can kind of see here that we've got the schedule laid out for the first half of 2025. Encourage you to, I think these are all on the website, but certainly you'll get communications about these. If any of these topics sounds interesting or fun for you, we encourage you to join us for any or all of these. Let's start out with a couple of, you guys all know me, I'm going to skip this part. Let's start out with a couple of survey questions. So we're keenly interested in here and what the current condition of your insurance vehicle is today. So the first question is, do you have a policy? You may not even know if you have a policy, but do you have a cyber insurance policy? We'll let Dana show the results once everyone is in.
Do you see them up?
Yeah. Okay. Looks like so everyone here has a policy. Okay, that's interesting. Next question is, you get to it, I promise. How confident are you that your current policy will cover you in the event of an incident? Some of your fingers. Or maybe some of you have actually exercised your policy, and maybe you are satisfied with how that came out, or maybe not satisfied.
Right.
All right. So it looks like only one out of, let's see, there would be about 15% of you are confident that it works for you, that you've got the right policy. Some of you are crossing your fingers. Some of them are sort of pretty confident. All right, last question. If you have exercised your policy, how well did it work for you? All right, looks like actually almost 30% of you have used your policy. And oh, actually even more than that. So almost half of the people here have exercised their policy and either covered some things or covered everything. About 60% have not had to use it, which is good news. So It's kind of interesting just to kind of see. 1 second, please. Technical issues.
You could a minute ago. You're muted now.
All right, awesome. So let's get started and let's talk, dig into this a little bit. I think there's some interesting things. So first, I think when we talk about insurance, it really starts and ends with, well, what's going on with cybercrime and small businesses today? And most of you have heard me say that I'm not a big fan of the statistics that come out of this industry, most of which are really intended for or drawn on enterprises or other organizations who are required to report incidents and events. At the small business level, we don't see that kind of enforcement. So again, cybersecurity statistics tend to be a little wonky the smaller you get and less relevant, honestly. But I think there's a few things that are important. First is really this started in 2022, right in the middle of the pandemic, when we saw massive cybersecurity incidents really becoming mainstream and affecting everyday life, right? So whether it was a hospital or health system or your gas station or the people who were packing your meat, nationally, we saw major disruptions in these services and these conveniences directly due to cybercrime and other events, cyber-related events. And this, I think, brought a lot of visibility to cybercrime and how it might in the future manifest and become more impactful to small businesses. Again, I think for a very long time, we've been dealing with cybercrime at the enterprise level. In all of the major stories, Target, Home Depot, Sony have been enterprises, right? The ones that we pay attention to. Now, cybercrime at the small business level, in my experience, or as far as I can tell, was actually far less impactful to smaller organizations because it wasn't as economically feasible and there wasn't as much bang for the buck going after a 25-person ball bearing manufacturer. And so that's changing for sure. But let's make no mistake that cybercrime affects our businesses increasingly so. And in some ways, it's a global, the connectedness, it's just a global impact. Now, again, we're not really sure what's happening in cybercrime with small organizations. So these are some FBI statistics. They have no incentive to fake these numbers or to modify them in any way. So the FBI, according to them, in 2021, just over $3 billion in losses. That could be anything from ransoms paid to opportunity costs to regulatory penalties. Their estimate was 62% of all small businesses had experienced some type of cybercrime. Again, a big question mark on that number just because most organizations don't report. So we do know for sure that any statistic you see is really just getting part of the picture. And then, of course, it's growing. We know it's not getting better right now. So while we don't understand the statistics, we don't have specifics necessarily, especially for smaller organizations. What we do know is that cybercrime and cyber-related issues are increasing in frequency and severity. And we have experienced it ourselves. Honestly, for the first 4 years of our business, we may have dealt with maybe 5 incidents the entire 4 years. Over the last 6 to 9 months, it's been a different story. We have seen this happen significantly, and we probably have experienced more incidents in the last 9 months than we did for the entire prior life of the company. So it's happening. The economics are changing. It's become easier for cyber criminals to target smaller businesses. The advent of automation and things like, I hate to use buzzwords, but certainly things like machine learning and AI are making it cheaper. I would argue that they're not any better. The attacks are not any more sophisticated, but certainly they're less expensive. And so we're seeing more of them. And with automation, it becomes much easier to conduct these types of these types of attacks as well. But the question really is not where we've been, but where are we going? And today, because we just don't have the actuarials, right? Because no one's reporting, say no one, but statistically insignificant percentages of small businesses are reporting their events and incidents. So we don't have a good sense of the real trajectory of cybercrime for 2025 and beyond. So a major question mark for us, but that leaves us to a point where we have to say, or we have to put some trust in insurance, or better put, in terms of nerd speak, the ability to and the transference of residual risk or infeasible risk treatment. I'll explain what that means momentarily here. Let's talk a little bit about the cybersecurity insurance industry. First, I call it wild flux, but we have seen constant conflicting reports on premiums, on policies, on coverages, on the expectations and the controls and cybersecurity protections that are required. So it's really all over the board. And we review a cybersecurity policy at least once a week, I would say today, because we are helping all of our customers get better policies at better premiums. And there's a lot of interest there. So we're doing a lot of work in this space. And I will say, and New York State DFS requires me to say that I'm not a licensed broker or a registered agent of any carrier. However, we do see a lot of policies. We see a lot of good policies. We see a lot of bad policies. We also see and experience policies being exercised, right? So in the middle of a claim, when one of our customers is trying to get paid for damages that a policy is intended to cover. So we do see a lot of this, and wild flux is probably a generous term. It's all over the board. I will tell you that even our own policy, and we do obviously a lot to protect our own business, but with coverages remaining identical between 2024 and what we're doing or intend to do in 2025, our premium has tripled. So just to give you a sense of what we're experiencing as well. It's getting harder to get. Oftentimes, small businesses can't get the policy that they want. And a lot of that comes from, let's say, a big customer of yours. So our customer's customer may say, hey, listen, we need you to carry 3 million or 5 million in insurance coverage. And there simply aren't carriers or underwriters out there who are willing to write a $5 million policy for a 50-person healthcare practice. They're just not going to do it. And so it's getting harder to get, but in not just in terms of the insurability, but because of the applications themselves, which are becoming much more intense, right? So 10 years ago, it was 5 questions. You just said yes, 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 yes to everything. You ended up with a policy, and it was a pretty simple exercise. Today, that might be 5 pages of questions. And it's going to ask you about multi-factor and backups and encryption and incident response and training and things like that. So the applications are becoming more complex, more intense. But in addition, something I'm going to hit on here momentarily is the verification that occurs now from a carrier. They may be asking for evidence. So if you say, hey, listen, yeah, I'm training my workforce on a monthly basis, they may say, oh, okay, that sounds great. Prove it. We want to see your compliance report. So that is happening as well. Additionally, the policies are becoming more complex because insurers, the carriers and underwriters really took a bath, I would say, from like 2015 to the early 2020s. They were getting crushed because they didn't know how to price policies, because they didn't have actuarial data to understand how often does cybercrime occur, what does it cost, what is a claim typically worth. And so, the big players like AIG and Chubb and Lloyd's and Beasley, who were kind of first movers here, they were the first ones to really jump on this market. They got crushed. And so the policies are becoming more complex, harder to read, harder to understand, harder to shop. So it's like buying a mattress now. You can't go out and compare apples to apples. Everyone uses slightly different terminology, or where, where they stage their retentions or sublimits. Even the term ransom, you might see that in a policy, or you might see extortion. And are they the same thing? We don't know. So the policies themselves are becoming more complex. I kind of touch on verification. The farther we move into the future, the more you can be expected to need to prove everything you say yes to. And we're seeing this with underwriters and carriers like Coalition. Coalition will actually do a scan of your open source information. And as part of your application, and you sort of submit to this, what they're going to do is they're going to scan your websites and your public facing infrastructure, and they're going to look for certificates and things like that to get a general sense of how cyber savvy is this organization. And then they compare it to your application. So if you just said yes, yes to 100 questions, yet you've got expired website certificates in the wild, they're going to say, this feels fishy. We did some verification, and what's happening in real life, what we've been able to prove just based on open source intelligence, does not match the security culture or what you are suggesting the organization is doing today. So verification is becoming very common. I can guarantee that what Coalition and others are doing, every carrier at some point is going to be doing the same thing. Carriers are becoming more specialized. So we all know that there are 3 types of organizations that absolutely cannot get insurance today. That is IT providers, believe it or not. So MSPs, terrorists or terrorist organizations, or anyone related to a terrorist organization, and then cannabis dealers. However, carriers are also figuring out that they might understand healthcare better than they understand manufacturing or technology. And so as the actuarial science starts to catch up, carriers may just be abandoning certain market segments. And if you're in one of the segments that isn't covered, well, then what happens is the shoppability of your policy is more limited. You've got fewer carriers and underwriters to choose from. So even if your broker could represent all 50 or 60 carriers, which they don't, they typically are only going to represent maybe 5 or so, that the field is narrowing. So if you're in technology, you may be looking at a subset of the carriers out there. So that is making it harder. And then later, right, so moving forward, when you get to the point when you're claiming, or you claim against that policy, it's very likely that the carrier is going to insist that you use their legal firm, their crisis communications firm, and maybe even their cybersecurity and forensics investigation firm. Because what's happened is that, let's face it, carriers, insurance companies, they don't make money paying claims, they make money charging premiums. And so they're in the business of minimizing the number of claims that they pay and the amount on each of those claims. And so they want to make sure that these claims and the investigations are adjudicated in a way that is, I hope, fair, although I would argue there's a conflict of interest here. And so they're injecting their panels. And a panel is basically, let's say, 6 law firms that they trust to go in and do the work when there's an incident or an investigation. And so we've seen this happen increasingly. It's not to say that there are no ways around this. And we've certainly been successful convincing a carrier that we can reduce the volume, the amount of the claim, because we already know the organization, we know their infrastructure, their data, et cetera. So it does happen, and I think we're pretty successful at convincing carriers when necessary that we are really the best option, but not always. And we have definitely seen these things get really ugly. And I'll talk about a story here at the end of the presentation. And then, of course, the premiums are all over the board. Ours tripled from 24, 25. It stayed roughly the same between 23 and 24. But I know of one customer who experienced a 10x increase in their premium and a reduction in coverage at the same time. So 10x increase in their premium for less coverage. And so, again, really all over the board here. Okay, so that's kind of what's going on and what we experience, kind of what we're helping customers with today is navigate some of these challenges. Let's talk about some of the basics. So, all of you looks like have policies, which is awesome. We really encourage every customer to have a vehicle where for the things that are just infeasible, inaffordable, or otherwise just impossible, we want to have a way to transfer risk and to cover some of the expenses that might come along with a cyber related event. So let's talk about some of the basics. First, cyber insurance at its core, the intent and the goal is to cover risks that are otherwise infeasibly covered, but those risks are due to the compromise of confidentiality, integrity, or availability of data. And usually this is protected data like EPHI, PII, and NPI, CUI, all of the acronyms in our industry. Like confidentiality, I think everyone understands, right? So no one should have access to the data that isn't authorized. Integrity would be that, for example, it's not corrupted or there weren't changes, unauthorized changes to the data. And then availability means, is the data there when we need it? So ransomware is a great example of an availability compromise, and potentially other things too. So this is what we practice. This is why cyber insurance exists, is to transfer these infeasible risks and costs and expenses to a vehicle that can deal with the compromise of confidentiality, integrity, and availability of data in the event of a cyber-related incident. So that's important to know, because I think there's a lot of misperceptions around what cyber insurance is really intended to do. Now, there are really three ways to figure out what residual risk really looks like. And given that you're all customers, most of you, if not all, today are pursuing risk management in several ways. The first is what you should do. So a risk assessment. If you are a compliance assessment customer of ours, then on an annual basis, you are getting a compliance assessment and a risk assessment in a single activity. And that's what you should do, right? A good risk assessment is gold. It tells us what should we be doing? In what order should we be doing it in? How much of it should we do? And it's really one of the best ways to build a cybersecurity program, because ultimately this is about risk management. However, there's another option, which is what you must do, and that's a compliance-based approach. And some of you face a lot of regulatory scrutiny. The DoD supply chain, manufacturers in the DoD supply chain is a good example where you're experiencing a lot of enforcement in terms of NIST 171 or other compliance. So what you must do, and then there's what you can do, right? So this is sort of the capability model. Now, each one of these has their advantages and disadvantages, but ultimately you're building a cybersecurity program at the pace that feels comfortable for you, in the budget that you can afford, et cetera. However, all of you are in a situation where you can't do everything that you would like to do or that we would like you to do. And so that leaves deficiencies or gaps or vulnerabilities. And these vulnerabilities become risks potentially. The cyber insurance is really this blanket where we say, okay, we've built this program, we've done a risk assessment, we understand our compliance mandates, and we sort of built a plan. However, for all of the things that we can't get to, right, these important risks that we cannot address feasibly, we're going to transfer all of that risk to an insurance vehicle. Now, a couple of important points. First, these are designed to work together. So a couple of things come up frequently. One is, well, I don't know what my residual risk is. That's a very common question because it's not an easy thing to quantify. If you've done a risk assessment, it's much, much easier. It kind of gives you that answer, meaning here's the list of things that we're not ready to or we couldn't possibly address. We need to cover these. So your cybersecurity program doesn't replace insurance. And insurance is not a cybersecurity program. The idea is that they work together as a system where you're a cybersecurity program, you address the risks and treat the risks that you can, right? The risks that are feasibly treated, and then the others you transfer. But they're designed to work together as a system because then insurance picks up where your cybersecurity program leaves off. Now, if done well, they can reduce your net spend. So for example, if you said, hey, I'm going to forego cyber insurance, I'm just going to do all 1,000 things that I can do in cybersecurity. I'm just going to do all 1,000. Well, economically, that probably doesn't make a lot of sense because there are some things that would be very expensive, time consuming, or require a lot of energy for a small business. It just doesn't make sense to do some of these things. On the other hand, if you say, hey, listen, I'm going to skip the cybersecurity thing, that sounds like a pain. I'm just going to get an insurance policy. Well, first of all, it's probably not possible today if you don't have a program and aren't meeting some of the basics, which I'll talk about. But even if you could, that insurance policy would cost you way more than just building a cybersecurity program. Done well, these things can reduce your net spend because you have treated the risk that you can and transferred the risk that you can, right? They work together as a system. Okay, so often the first question is, well, how much coverage do I need? There's a couple of things to consider. First is, what do you have? What's worth protecting? If you're handling health information or medical records, if you have government secrets, if you have intellectual property, if you have credit card information, if you've got other intellectual property that just you consider sensitive and value, something that someone else may want, you need to make a list of those things. And we call it an asset inventory. Right? And we've talked to all of you about asset inventories. It's a little harder than it sounds sometimes because we really care about data. We don't really necessarily care about, storage or firewalls or iPhones. It's really about the data that lives or is sort of transformed over those things. So what assets are you protecting? How many of them? What's the value? Who wants them? Right? So what are we protecting here is the first question. The second is, well, how risk averse or risk tolerant are you? Some people are uncomfortable with any kind of risk and they want the maximum coverage. Some are willing to roll the dice, and there's no right answer. This really comes down to your culture, your corporate values, what market segment you're in. So if you're a hedge fund, you're probably in the risk averse. But if you're a small landscaping firm, then maybe you might be a little more tolerant of these types of risks. So that's a personal decision that's really made on a company by company basis. Another thing you should understand is that your policy should address and cover residual risk and no more. Now, this is problematic because you might have contractual obligations that far exceed your residual risk or what it would cost you to cover your residual risk. So you have to look at both. We oftentimes see situations where our small business customer, they themselves have big customers, and the big customer is a one-size-fits-all shop, where they just say, hey, listen, every one of our vendors, they need to have $5 million in coverage, no questions asked. And so we have had to advocate on behalf of our customers and say, hey, listen, let's talk about this because this organization doesn't have access to important assets, or it's not persistent, or we kind of have the risk conversation. But if it's written into a contract, you may not have much wiggle room. So understand what you've committed to in your customer contracts and potentially other supply chains. If you're a subcontractor, what you've committed to in your contractual obligations, there may be minimums that you need to maintain. Oh, and you may also want to consider other policies. So when you think about your ability to recover losses from cyber-related events, some of it's going to come from your cyber insurance policy, but some might come from your tech E&O or something else. Professional liability is another one that we commonly see. You want to structure your coverage so that you're paying, just like cybersecurity, you want to look for the minimum. What is the absolute minimum that you should get without jeopardizing the mission of the business? So in terms of how much, there's a lot of things to consider. What I would argue, though, for most of our customers, a $1 million policy with reasonable retentions and sublimits and coverages is a pretty safe place to start. Now, we do have bigger, more sophisticated customers that might be dealing with money or lots of it, or might be directly in the federal government. They might be building, turbines for the F-22. And in those cases, there may be more potential risk there. And again, if we're covering residual risk, that means that your coverages and the requirements may increase. Now, when you're evaluating cyber insurance policies, a handful of things that you want to make sure that you're looking for. Again, going back to the point we made earlier, which is these things are becoming more complex and the applications are becoming more intense. So the first is, does your policy cover the types of incidents that you are most likely to encounter? We saw and evaluated a policy recently that had an exclusion, which is a flat out, we don't cover this, had an exclusion for financial fraud. Now, if you ask, again, back to statistics, but if you ask the FBI what's happening with small businesses, yeah, ransomware is still out there and it's a big problem, but the likelihood of you experiencing financial fraud is about 100 times as much. So think about that. If the most likely incident is excluded from your policy, that doesn't sound right. You want to make sure that based on your business, your supply chain, the services that you provide, the data that you handle, what are we most likely to encounter? Again, a good risk assessment will help steer you in those directions, because once you understand your deficiencies and those risks, then you can kind of say, well, the loss of a laptop is a lot more likely than something else. Next is that third-party claims have become critically important because two things. One, you are much more likely to experience material impact from an upstream third party. So a vendor that you rely on experiencing an outage or a disruption or ransomware or something like that. Change Healthcare is a great example this year, but there's been so many in 2024. But additionally, you want to make sure that if there's a third party claim, so if one of your customers, as a result of one of your incidents, sues you, you want to make sure that that's covered. So I think of this as supply chain coverage, upstream and downstream, because we're all connected now, right? The cloud, software as a service, outsourcing, we're doing more and more of this. And so supply chain risk is critically important. Again, a good risk assessment can help you figure out what does that look like, understanding who your third parties are, which ones are critical, which ones have access or take custody of your data, things like that. Make sure you're considering third party issues. Make sure you review any exclusions that are in the policy. I talked about financial fraud, but we see these really popping up with different terms and just worded differently. So it's become very confusing to read through a 50-page policy document and say, okay, what are they specifically saying they're not covered? Some very common things are acts of war, acts of God, terrorism. There are others. Seeing an exclusion for financial fraud, though, that's unacceptable. And our recommendation would be you need to walk away from that policy. That's not a good one for you. Make sure you understand your exclusions, match them up to your business, again, in terms of aligning the policy with your residual risk. Start with the risk assessment, and then really understanding your business can really be helpful. So sublimits can also be a problem. You may have a $1 million policy, but if your extortion sublimit is $100,000, guess what? They're only paying you $100,000 on that $1 million policy if you experience ransomware. So understand what sublimits are. And then there's these things called hidden sublimits, which I'm not sure I totally understand, honestly, but I have heard stories where claiming on a specific sublimit in policy also counts towards a different sublimit. So whether it's breach notification or third-party recovery, it could be a lot of different things. make sure you ask your broker about hidden sublimits. And you want to make sure that the sublimits that are described in the policy, that they're in plain English and that you really understand what these things are. Because again, those are the practical limits of your claimability, right? Even if you have $1 million policy, if your PCI compliance sublimit is 250 grand, you're not getting all $1 million for that event. Retentions, right? So the deductible, so to speak. I'm not sure why the insurance industry calls them retentions, probably just to confuse people, but your deductible is going to be important as well. Understanding, one, financially, if you experience an incident, how likely is it that you'll be able to afford a retention? Are they reasonable retentions? So on $1 million policy, is it a $5,000 retention, which is actually quite low, or is it a $100,000 retention, which is obviously ridiculously high? So understand the retentions. There may be retentions on different sublimits. Although we don't see that very often. Typically there are retentions for like per policy, but there's fine print, and we want to make sure that you understand that this is the deductible. You're going to pay that first before the insurance carrier starts pitching in. And then last, most carriers today are requiring that you involve your quote unquote cyber breach coach early in the event process. So if you suspect that you have been hit with ransomware, or that you are missing 200 grand from a payroll account due to financial fraud or whatever it is, most policies today require that you notify the carrier within a certain time frame, and usually it's 72 hours or less. It's usually very fast. And the idea is that if you don't notify the carrier in due time, then your claim is not going to get paid. You're essentially disqualified. Now, there's sort of no way to win here, because I would argue that there's a lot of different problems here. Notifying and trying to describe an event in the first, let's say, 24 to 72 hours can really be difficult. And at times, you don't have enough information, right? You haven't concluded an investigation. You're not sure what data has been impacted or compromised. You're not sure what root. So all of these things that we try to achieve during incident response and all these questions we try to answer, we may not have any of those within 72 hours. So it's likely that we're going to give inaccurate or incomplete information to anyone who asks. So that's a challenge. Second challenge is that once we introduce a carrier's breach coach, guess what? They're going to start asking for specific things. They're going to make decisions on your behalf, and they're basically going to say, hey, if you want us to pay this claim, you're going to do X, or you're going to do Y, or you're going to hire our panel attorney. Like we're sending our attorney in there to run this whole investigation. But the third thing is, and I alluded to this earlier, and it still irks me that we haven't solved this as an industry, is that there's a real conflict of interest. Because again, your carrier doesn't want to pay your claim. And for them to be evaluating or driving a response effort that ultimately impacts the claimability or payability of an event seems like a salacious conflict of interest to me. It is what it is, right? We're in no position to make those types of demands. So I think the cyber breach coach thing, understand what's required of you, right? We want to make sure that we comply, but also know that there's some really, again, this is my opinion, but there's some really sketchy stuff that goes on once, or potentially. We have definitely seen some carriers and underwriters who have acted above board. They were supporting their customer, they were supporting their insured. And so I'm not saying that the entire industry is sketchy. What I am saying, though, is just this arrangement opens the door to a conflict of interest. And you want to make sure that you understand what that is. I'll talk a little bit more about a story that we experienced. It was a customer. Well, they weren't a customer at the time. They came to us with an incident, became a customer. And I'll talk a little bit about what happened there. Okay, so what's the best way to be insurable? I'm going to throw all of these up there. So what's happened, unfortunately, is because carriers and underwriters originally treated cyber crime like a tornado or a hurricane or a flood, and they took a bath for doing it that way. And because we're really missing all of this actuarial data, what's happened is that the cyber insurance industry has been forced to kind of throw things at the wall. They're not cyber security experts. You might argue that they understand risk, but maybe not data risk. And so we see a lot of questionable things going on, and not to demonize them any more than I have, but rather to suggest that we as an industry haven't done a great job of identifying these things either. However, all of you have applied for and gotten insurance, and you've seen these requirements, right? MFA, endpoint detection, training. So all of these things are on your application. Now, the carrier may have no idea what any of these things are. Your broker definitely doesn't know what these things are. I say definitely. Increasingly, they do know, but brokers are insurance experts, not necessarily cybersecurity experts, and so it's kind of unfair to ask them to be experts in all these different areas. But you've all seen these things. But related to my last bullet here is that one of the downsides is, due to this lack of experience, skills, expertise in cybersecurity, the cyber insurance industry is really beholden to whatever new fancy gadget is out there, right? So multi-factor is a darling right now, although we see multi-factor compromised all the time. So we're not sure why people think that multi-factor is like the end all be all to cybersecurity. But right now, the cyber insurance industry prioritizes this because, well, that's the perception. Same thing with an incident response plan or immutable backups. Like having an immutable backup doesn't mean much if it's out of date, or if you can't get to it, or if it's encrypted or ransomed. So again, carriers and underwriters, I think they do their best. Let's give them the benefit of the doubt. I think they do their best to understand and build into a formula, what do these things mean to a organization's insurability and risk, aggregate risk. But ultimately, I think they're tied to a lot of the perceptions and nonsense that comes out of our industry. There's a lot of hype and hysteria. Not all of it's really meaningful. And because we don't do a great job, I think, of educating them, and they have some accountability too. I think they don't do a great job of getting educated, that we end up in this area where the headlines sort of drive policies and premiums, not what's really happening on the ground and where risk truly lives. But being insurable is about being able to say yes in a relevant way, in a provable, auditable way to the requirements. Every application is different. Every carrier has their own application. And so if you are smart and shopping your policy every single year, you've seen probably dozens of different applications, and they're all different. And some lean more heavily than others on these different types of controls. But the best way to be insurable is to have these controls, especially the ones that are listed here. And maybe even more importantly, make sure you can say, no, I have not experienced an incident over the last 12 months. I'm going to make one point about response here, because this is not an incident response presentation, but in your response process, you want to avoid having to declare an incident as long as possible, right? Because cyber activity might become an event, meaning it's something we got to look at, and an event may escalate to an incident. And so this is a very important process. These definitions are very important. And in the analysis and investigation of a potential incident, you want to work really hard to not have to formally, officially declare an incident, because then you have to say, yes, we experienced something in the last 12 months. And of course, that puts you in a whole different risk pool. So do these things and don't declare an incident in the last 12 months. That makes you more insurable. Oh, and don't be a terrorist. Okay, I got a couple of final thoughts, and then I'll take some questions if there are any. So throw those in the Q&A or the chat, and Dana will pick those up in a few minutes. Okay, so The first is, and I think I'm speaking to the choir, I was not expecting every attendee to have an insurance policy. But the first thing is that cyber insurance is critically important today, but it's not going to prevent the accident. So going back to your policy and your program working as a team, it's a partnership. You have to understand that just because you have a great policy that covers all the likely incidents, it's got good sublimits and retentions, and it's not going to stop cybercrime from happening, right? So make sure that you understand the balance between prevention, detection, correction, and transference. Now, these are all sort of nerdy risk management terms, but you got to recognize that just because you have flood insurance doesn't mean you're not going to get flooded. They're completely unrelated. And so understand the balance there. Very important. Also, having a great insurance policy may end up assisting financially with some of the losses that you experience, but it's not going to fix your car, right? So you have a car accident, you may get paid, or your mechanic may get paid, but it's not going to do the fixing. So the 2 months that your car is in the shop, the fact that it comes back to you with, non-OEM parts or doesn't feel right, not going to change that. So insurance is a reactive control to address losses and other types of damage from something that's already happened and already caused damage. Again, program first, then transfer your residual risk. That's the way the system works best. I think I've kind of hit on this. The story is, and this is going back probably, I think, May or June of this year, a small organization came to us experiencing a fairly significant, 60 employees, but essentially everything was extorted. And went to claim on their policy. Carrier said, sounds great. Thanks for getting us involved. We appreciate it. We're sending our attorneys and cyber insurance or cyber security company over right away. And the organization said, well, we have general counsel. We have counsel on staff, a full-time attorney that can handle all of this, whether it's data breach notifications and et cetera, et cetera. We're also we've identified a cybersecurity firm that we'd prefer to work with. They're local, they know us, we trust them. And the carrier said, thanks, but no thanks. You're using our team. Now, what ensued was really one of the worst experiences of my career, going back now 25. And eventually the cyber forensics firm produced, for, I think expenses were close to 20 grand just for the investigation, they produced a 4-page report. So 4 pages. So the report was entirely inadequate, although it was all the insurance carrier asked for. Additionally, and far worse, was that I think the sublimit or the coverage for the insurance firm was going to pay up to $30,000 for legal fees in this particular incident. So the law firm that was injected did a bunch of fluff work to get to the 30, and then they started doing the real stuff. So this poor organization experiencing ransomware, they were, down for at least 2 weeks, and they're a manufacturer. So this was real money. So they were down for 2 weeks, and now this law firm comes in and they're just like shark bait, just milking them for every single dollar. When we finally got involved and we were looking at what the law firm was producing for them, we said, you need to call them tonight and fire them. Tell them, thank you for the work that you've done. We no longer need your services. And they did. And it probably saved them another $30,000. But the whole system is a little wonky right now. So just keep in mind, these panel providers, they don't work for you. And even though this law firm was still bound by ethics, the bar ethics and, industry ethics, that they had no problem doing the wrong things for a very long time and then overcharging the customer. So keep in mind that you probably have very little authority over what decision your carrier makes on panel providers. But if you end up with panel providers, you want to make sure that you understand exactly what they're there to do, make sure you're tracking their work, asking hard questions, and maybe getting a third-party advisor involved. That's really important. And last point I want to make here is this: we shop our policy every year. We have some great partners, and we introduce partners to our customers. And many of you have switched to our partners, which we think is great because we do try to vet them hard. But even we shop our policy every single year across everyone that we can. So we gave 3 different organizations 2 customers who were in the insurance business, and then we also our national partner. And as it turned out, the provider, our broker for 2024 is not going to be our broker for 2025 because, well, we shopped and we got a better policy at a better premium. I'd say don't make this like a personal thing. You should be shopping that policy every year until these things start to settle down. The likelihood, and we were surprised this year. We honestly, the provider that we ended up going with, we're like, dude, wow, we're kind of surprised. We sent this to you as a courtesy because you're a great customer, but we fully did not expect that you were going to beat this price, and they did by a significant amount. So I would say make it a practice to shop, and if we can help, please let us know. Again, we have some really great partners, a national partner that all they do is cyber insurance for small businesses, and then we've got a couple of local brokers as well that we just love and have done great work for us. So please ask and let us know if we can help. And with that, I will turn it back to Dana to see if there are, let's see, any questions. So Dana?
Thanks, Reg. That was great. So I don't see questions yet. If anybody has any, please enter them into the chat or the Q&A.
Last point I'll make here while you guys are thinking about this is that your customer success specialist will be bringing this topic up with you on an annual basis. So if we don't, or if we haven't already talked about cyber insurance yet, make sure you bring it up in your next OrbitalFire Cybersecurity review meeting. We want to track your renewal date so that 60 days in advance, we can help you shop that policy or answer questions, talk about your residual risk, and just make the process easier. So
that's great. And as usual, Reg, I think you did such a great job going through the key points. I don't see any questions. And so I will just remind everyone, as I know you always do, that if you think of anything after this, just feel free to reach out to your customer success specialist, to Reg. We're always here for you to support you and answer any questions. And I will be sending this out as a recording in a few days. So if there's anybody else in your organization you want to send it to, or you want to review it, you will have it there for you. With that, Reg, I think we're ready to say thank you. And I don't know if you have any final comments.
just thank you. Thank you for your time today. Hope this was helpful.
Great. Thanks, everyone. We'll talk soon.